Hello guys and welcome back. So Zoom Video had its earnings report and it looks like it was a beat and the stock was up 20% at some point in the after hours market. But right now it's actually down to almost 5%, so it fell a lot from 20% to almost 5% of a gain right now. We'll see what's going to happen when the market opens tomorrow. Maybe this has to do with the fact that the market is looking to have a down day potentially, maybe because of Snapchat that's down like 30% or something. Although typically when you have an earnings report, it's not really affected by what is happening in the overall market. But yeah, it's interesting to note that this has gone down a lot since the after hours actually stopped. Okay, so let's take a look at what happened in terms of the earnings report of the company. So as you see, Zoom stock soared 20%, which is not happening anymore, on Q1 results. So net income at 113.6 million versus the year ago figure of 227.4. So this is a drop here. Per share earnings of 37 cents, significantly below last year's 74 cents. On an adjusted basis, that's adjusted EPS, 1.03. And the revenue went up 12%. The consensus was for 88 cents of adjusted EPS, so they actually beat that on 1.07 billion in revenue here. Operating margin was 17.4%, and Zoom Phone reached 3 million seats in Q1. Now the fiscal 2022 outlook here, they forecast earnings to fall between 3.7 and 3.77 and 4.55 billion in revenue. Now, you will see here that Zoom's Q2 guidance was slightly better than expected, which means it's typically something that people will like right now in the Wall Street, because if you compare it to what is happening with the overall market, this is a pleasant surprise here. Very interesting to see. Although some of the reported metrics here do not look great here. Again, the net income was actually lower than last year's figure, which is, I guess it was expected because the actual consensus was for 88 cents for an EPS. So they actually expected less, it looks like. So potentially the analyst estimates were actually much lower. There was a steep decline in the stock price of the company, and maybe they expected less, and this is why they beat. Okay. Let's see what happened here. The stock has been down about 78% here, and that's insane, from $406 to $89. And if you take a look at the max chart here, you will see that it's been going down and down from the $400 time, really. And actually, it was even higher, as you'll see here, but 400 was like a year ago. But if you take a look at the last year, it's basically a story of a downtrend for the most part, as with many stock prices, with many stocks right now. Now, after having fallen that much, the stock has a P/E ratio of 19.9, so it looks like it's down to earth. Price to free cash flow of 18.3. Outstanding shares that have been increasing, and it's something that I don't like, of course, because it means that the company is diluting the current shareholders. And of course, if you become a shareholder, you don't like this to happen with your shares. Now, the total liabilities to free cash flow ratio is actually rather low, which I like to see. That it looks like the company doesn't have a lot of debt. Because this ratio means here that the company can pay all their total liabilities, that includes debt and everything that they own. It could be even paying suppliers, just in 1.2 years, pretty much. So that's great. And we'll examine the finer details a little bit later. But the revenue growth of the company has been amazing. Same with the net income growth, free cash flow growth, total equity growth. The company has been growing tremendously well through the last few years. And very little debt, as you'll see here. And current assets compared to current liabilities much higher, 3.6. So that's another good thing to see. No long-term or short-term obligations that cannot be fulfilled. Return on equity that's rather high as well. Very nice to see. And capital employed also. And actually their margins are fairly awesome here as well. 30% is nothing to sneeze at. Very good margins here. Now, let's take a look. They don't pay any dividends. And let's take a little bit of a look at the income statement. See what's going on. 150 million to 4.1. As you can understand, this is tremendous revenue growth here. And the even better thing is that there is awesome growth in terms of the net income. So the company is in an upwards trajectory and is doing pretty nicely. Now that doesn't mean that the stock is a buy, because we have to see whether it's expensive or not. Very important, because we like a company, but we may not like the stock if it's too expensive for the company at the current time. Now, if we take a look at the balance sheet, obviously the company has been issuing shares like crazy. You'll see it here in the additional paid-in capital, 3.7 billion, 3.1 billion, almost a billion here, issuing shares, a bunch of shares really. And total equity has been increasing. This is a big part of it, as you can understand. This is 3.7 billion out of the 7.5 of the total assets, so it's a massive amount. And let's take a look at the cash flow statement. Let's see if the company actually generates any free cash flow here. As you'll see, and we mentioned, the net income has been negative lately, and so free cash flow will be getting better, and operating activities cash flow is increasing 1.6 billion over here. You will notice that the company is investing in acquisitions over here for the most part, and some capital expenditures, and selling some maturities as well here. But in terms of financing, things are not moving much over here in the last year. Just a little bit of debt, almost negligible here. Same with the previous year for the most part. But yeah, they have been issuing common stock, of course. So that's something that we know about. And the cash that they have is 1 billion right now in their reserves. And the free cash flow, 9.6 million back in 2018. And right now it's at 1.46, which is fantastic. It's good growth over here. Now, we do need to examine whether it's a buy. And the way to know if it's a buy right now, based on the current stock price, almost 90 bucks, is to use a discounted cash flow model that you can use in our exclusive tool here. You can find this tool. It's actually linked in the description box below this video. Any Patreon can actually use this tool, and unlimited for unlimited purposes. Really, you can check all sorts of stocks that you want for your own sake on all sorts of projections. And over here in this one, we are gonna be using revenue growth that is lower than what the company has been achieving, of course, because we cannot go 50% or 60% for the next 3 years. Although the company has been the next 5 years, I meant. The company has been increasing its revenue fairly nicely here. So I'm gonna use something that's rather high, 15, 17, and 19, just because again the company has been growing nicely. Now, you may want to be a little bit more conservative, and I will also try that. But let's start with 15, 17, and 19 for the next 5 years. Net income margins a little bit all over the place, and this makes a ton of sense because the company is becoming profitable through the years and much more profitable through the years. So this changes, and we will go with something that's more appropriate for the last years, maybe something like 18, 20, and 22 here. Free cash flow margin, again, a little bit all over the place, yeah, we will go with something that's fairly typical, 80, 90, and 100%, and 13% for an annual return. When we're using a free cash flow margin of 100%, it basically means that it is the same thing as the net income, so it's basically 22 compared to the revenue. That's how it works, and 80% is basically 80% of this one. Okay, so calculate. And yeah, you will see that even with this kind of revenue growth, we are still a little bit overpriced here. Even our high estimates are sitting at almost 88 bucks. These are very close to the current price, actually, to be sincere. But the medium ones are at 66, low ones at 49. And if I went lower with something more conservative, which is probably makes sense as well, you will see that then we are actually much lower. We would like to get the company's stock at about maybe 50 or 40 bucks. Would be even better, and the high would be at 66, and we're currently at 94, I think we should be right now, because again we are in the after hours and it looks like it's rising, and it would have risen much more actually, but yeah, right now it's sitting at 93.6. Okay, so yeah, this company is getting better in terms of its stock price, but imagine, even after dropping that much, it's still not at the price that we would want it to be. It has to be lower, maybe again around 40, 50 bucks to be worthwhile, or to be worth our money, really, and so that we have a margin of safety and we can make money through the years without risking too much. Right now in this stock market, it doesn't make sense to be buying the expensive stuff, even if they're amazing companies. And I love Zoom a lot. I'm using it all the time. But you need to be buying the stuff that is cheap. You need to be buying the stuff that has been decimated, yet it's making great amounts of cash, great amounts of free cash flow, good profit and all that, and not gamble with these companies which will probably be doing well, but they're expensive. And I don't think it's a gamble in terms of the company. I mean, the company is great, but it's a gamble in terms of what the stock market will do with the stock price. Because again, it's a little bit overpriced for what you'd want it to be, and it makes a ton of sense to be buying it at a lower price. And remember, the company has also been diluting shareholders like crazy here, which is something that I don't like as well. They may keep on doing that, especially if the stock price goes up. You know, they have a history for that. So, yeah, good things here, but I would say stay patient and wait for a better opportunity. Let me know what you think about Zoom. Of course, please leave a comment below. I'm interested to hear your opinions for this one. It's an interesting company and it's definitely trending right now. But yeah, we'll see. We'll see how it's going to proceed in the next few years. Please leave a like and subscribe if you're not a subscriber already. And remember to watch this next video that I made about Snapchat a little bit earlier. Very, very interesting what's happening there as well. Another analysis of a stock that is in a massive trend, downtrend lately. And it's down 30% after earnings. Take a look at this one as well. And I'll see you in the next video, guys. Bye-bye.